Are you ready to take control of your wealth and design the life you envision for yourself and your family? Welcome to Wealth of Insight with Austyn Whittenburg from Wittenburg Wealth Partners. Austyn guides you through the entire planning process to help you build a plan that seeks to protect your financial future. He empowers you with creative investment opportunities and planning ideas to help you understand and achieve your long-term goals. It's time to gain confidence in your financial future. Now, on to the show.
Welcome back to the Wealth of Insight podcast. I'm your host, Austyn Whittenburg. Today, we're going to be exploring an intriguing strategy called the Backdoor Roth IRA. Now, many people have probably heard of the Roth IRA, and potentially maybe you've heard that Roth IRAs also have an income limit to them. So have you ever wondered how high income earners and families are still able to contribute to them? In this episode, we'll delve into the concept, the benefits, step-by-step process of how you can potentially implement the Backdoor Roth IRA strategy in your financial plan. We'll also touch about the tax implications and the importance of consulting with a CPA and a financial advisor as you do this, just to make sure you don't cause any issues that may affect your tax situation overall. So let's hop into it. First, what is a Roth IRA? If we're going to be using this Backdoor Roth IRA strategy, well, we need to understand what a Roth IRA is. So a Roth IRA is an individual retirement account that you can contribute after tax dollars to, money you've already paid taxes on, and that money will grow tax-free and you can take it out tax-free. That's one of the reasons people really love the Roth IRA, is it takes the tax variable off the table. Who knows what may happen in the future with tax rates and income brackets and all these other things, but once that money is in a Roth IRA, none of that matters. They could raise tax rates to be 100%, and you'd still be able to take money out of your Roth IRA tax-free. So there's some really powerful benefits to that Roth IRA. One of the other unique features of a Roth IRA is there's no required minimum distributions. Now, required minimum distributions are things we've talked about in the past, but for those who are saving in a traditional IRA or a 401k, at some point in the future, for most of you, that's probably age somewhere between age 73 and 75. The schedules the IRS has just recently updated depending on your birthday. But at some point in the future, with those retirement assets, you're going to have to pay these required minimum distributions. The IRS has a schedule. They say in each year, here's how much you have to take out of your 401k or IRA, and you have to pay taxes on that money at that time. So again, having no required distribution gives you a lot of control over your tax situation, because there's not going to be money forced out of your retirement accounts that you ultimately have to pay taxes on. Now, Roth IRAs traditionally have had an income limitation to how much you can earn, and then you're no longer eligible to contribute to a Roth IRA. So in 2023, that number is $153,000 for those who file single, and $228,000 for those married filing jointly. In 2024, those numbers will be $161,000 and $228,000 respectively. So those income bands have gone up quite a bit in the last few years because of inflation and how that's impacted the tax rates and the tax, the growing of those tax brackets. But still, there's a number of people who make more money than that who are still able to implement this strategy. So again, if you're making $300,000, $400,000, $500,000, you may have thought, I'm not eligible for a Roth IRA because of these income limitations. But using this backdoor strategy, there's still the potential that you can get money into the backdoor Roth. So why would you want to put money in a Roth IRA rather than just invest it on your own, right? So you have multiple options. Many of you probably have a 401k you can put money to. And side note, a lot of those 401ks may have a Roth option that would be worth looking at and considering because of those tax benefits in the future. So you can put money there, or you could just save it, in an individual savings account or something like that. So why would you want to put money into this Roth IRA? Because some of the downsides to the Roth IRA are, once that money goes in there, you really can't touch that money until retirement. So the way that the law is now is if you touch that money, if you take money out of your Roth IRA before 59 and a half, you're going to end up paying some penalties on that money and potentially taxes depending on the situation. So once that money's into the Roth, it's sort of locked up, and you should think about it as being locked up for the long term. So back to my question. Why would you want to put money into a Roth IRA knowing some of those restrictions? And the answer really is tax deferral. Tax deferral and the compounding of that tax deferral can be really powerful over time. I think I've mentioned this quote a number of times on the podcast, but Albert Einstein has said that compound interest is the most powerful force in the universe, right? So that compound interest inside of a Roth can be even more impactful. And this applies also inside of your 401ks or IRAs as well. So just this tax deferral in general can be a really powerful strategy, because traditionally, if you invest money just in a savings account, or you buy some S&P 500 index funds or whatever that may be, each year you're going to pay tax on the interest that you earn, any dividends that they kick out, as well as capital gains, potentially if you're moving investments around, right? So interest, your tax ordinary income, any capital gains, things like that will be at the capital gains rates. So there's just taxes that you pay all along the way having these investment accounts. Inside of an IRA, 401k, Roth, etc., you aren't paying any of those taxes. So to play that out, you own the S&P 500, it kicks out some dividends, and then you want to reinvest that dividend. If it's inside a Roth or an IRA retirement account, you can invest that full amount back into the S&P 500 and continue to compound that. If it's just in your name, traditional savings account, et cetera, when that dividend pays out, you certainly can reinvest the whole thing, but you're going to have to pay taxes on a portion of that just dividend or interest that is earned over time. So over time, that eats into your overall return because you're not getting that full reinvestment of the dividend and interest. So this tax deferral can be really powerful. AllianceBernstein put together a report, and they looked at a hypothetical situation. So keep in mind, this is hypothetical. It's not a real life situation here, but they took $100,000, assuming that it grew at 8%, and that this person who had this money was paying a 33% tax rate on capital gains, interest, et cetera, over time. So again, hypothetical situation. If you took 100 grand, 8% per year with that 33% tax rate, at the end of 30 years, if you put it in a tax deferred account, IRA, Roth, et cetera, that 100 grand, because of this, the compound effect of that tax deferral, grew to be just over $1 million. Without the tax deferral, that 100,000 grew to be about $478,000. So a pretty substantial difference there in that tax drag, is what they would call it, tax drag of paying those interest and capital gains and dividend taxes all along the way. Even if you put that in an IRA and you take a lump sum withdrawal distribution, your $1 million then becomes, closer to 700,000, still higher than the 478,000 you get along the way. So again, hypothetical illustration, but can show you the power of that tax deferral. And that's really one of the strongest pieces to the Roth IRA and why it really can fit in your financial situation. It's because it gives you that tax deferral, and that can be really powerful over time. Now, again, this is not some strategy that only we know or that's in a gray area. This is something the IRS knows about. They continue to allow, but you want to make sure you follow the correct steps here. So let's talk about the steps to funding a backdoor Roth IRA. You really, in this, to employ this strategy, you're going to need to have a traditional IRA as well as a Roth IRA to be able to make this happen. And that hence the backdoor name, right? So the money, you make a non-deductible IRA contribution. So money goes into your IRA. Normally, when you put money in an IRA, you write that off on your taxes. In this instance, you put money in your IRA, you do not take a tax deduction on that money, and then you convert that money from the IRA over to the Roth. So you won't pay any taxes on the portion that you convert that's non-deductible. If there's any growth from the time you contributed it to when you convert it, you will pick up some taxes on that potentially. So something to keep in mind. It's not there still may be taxes incurred along the way, but should be minimal depending on your situation. So Those IRA contribution limits, right, for 2023 is $6,500 or $7,500 if you're over age 50. And for 2024, that's $7,000 and $8,000 respectively, that you can contribute into this IRA and then make the conversion. And if you're married, you can also do that for your spouse as well, right? So you can see how over time you're able to get pretty significant amount of money into a Roth IRA using this strategy, and are able to benefit from the tax treatment that a Roth IRA receives. So there are a few things to consider here. Like I mentioned, there may be taxes that you will owe if you've seen growth on your investment in the IRA before you contribute it. So something to be aware of. You want to make sure that you're aware of any taxes that you may owe, just so you're prepared, when tax day comes and when the bill comes due. And this really isn't the most ideal strategy if you have a large IRA balance. It works best if you have no IRA balance to do this, because of the way that the IRS treats those conversions. So if you have a large IRA balance, let's just, to make the math simple here, I'll use an example. Let's say you have $95,000 in an IRA. You then make a $5,000 non-deductible IRA contribution. So now your total IRA balance is $100,000, and you want to convert that non-deductible piece over into your Roth IRA. Unfortunately, the IRS doesn't let you do that. They treat all conversions as a pro rata conversion. So they would take a look at that 5,000. Well, 5,000 is 5% of 100,000. So when you made that $5,000 conversion, only 5% of that conversion would be treated as a tax-free event. The rest of it you would pay taxes on. So you really want to make sure you understand the math there, and again, understand the tax implications. It is good to note that 401k balances don't factor into that equation. It's really only IRA balances. So if you have an IRA that you've rolled over from a previous employer or something into an IRA, that's when it matters. If all your money's in your 401k and you make these contributions and conversions, they don't factor in that balance. So just, again, another thing to review with your CPA and your financial advisor, just to make sure that you're following the steps. I really think a Roth IRA can be a critical piece to your overall financial picture. It takes away the tax variable. We know we're never going to pay tax on that money again. We see really good growth because of this compound of that tax deferral, right? We're not paying dividends and interest and all these taxes along the way, right? We get to wait until that money is withdrawn, or again, in the case of a Roth, we never pay tax on that money again. So it can be a really powerful tool to control the tax situation in retirement. And the more money that I can get for clients in these tax-free buckets where we know we don't have to worry about the taxes in the future, we really strongly encourage that and like to, make sure that's a good fit for clients' overall portfolios. So as I mentioned, it's important to work with your CPA and financial advisor on this, just because the rules are always changing. I mentioned, hey, the IRS knows about this strategy. It's not something they're against. They allow it as long as you follow the correct steps. But it is something that is always on the table in Congress as a potential, some may call it a loophole, right, or backdoor that they may look to remove. So you want to make sure you're staying aware of any current tax law changes and how that may impact this strategy. So work with your CPA and financial advisor to make that happen. If you think this could be a great fit for you and you'd like some more information, please feel free to reach out to us. You can find us at our website at www.wittenbergwealth.com. You can always text me at 801-839-7056. Please remember to subscribe and share with your friends and family.
Thank you for listening to the Wealth of Insight podcast. Click the subscribe button below to be notified when new episodes become available. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Stratos Wealth Partners, a registered investment advisor. Stratos Wealth Partners and Wittenburg Wealth Partners are separate entities from LPL Financial. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Wittenburg Wealth Partners. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.